Sustainable finance and social impact. Introduction. In an era of growing environmental concerns and social inequalities, the concept of sustainable finance has emerged as a transformative approach to economic growth. Sustainable finance focuses on integrating environmental, social, and governance (ESG) factors into financial decision-making. It goes beyond profit maximization by emphasizing long-term value creation, social impact, environmental stewardship. Sustainable finance. Sustainable finance refers to financial services that take into account ESG criteria in investment and lending decisions. It aims to promote environmental responsibility by funding projects that combat climate change, reduce carbon emissions, and support renewable energy. Enhance social equity by addressing issues such as poverty, education, healthcare, and community development. Ensure good governance by fostering transparency, accountability, and ethical practices in businesses and institutions. Principles of sustainable finance. Sustainable finance is built on several key principles. Integration of ESG factors. Investors and financial institutions consider the environmental and social impact of their decisions, alongside traditional financial metrics. Long-term perspective, prioritizing investments that generate sustainable value over time, rather than short-term profits. Stakeholder inclusivity, recognizing the interests of diverse stakeholders, including communities, employees, and the environment. Transparency and accountability, ensuring clear communication and ethical practices to build trust and credibility. Social impact of sustainable finance. The social dimension of sustainable finance focuses on creating positive societal outcomes. Key areas of impact include poverty alleviation, by funding initiatives that promote economic inclusion, such as microfinance programs and affordable housing projects. Improved access to education and healthcare, by investing in schools, hospitals, and public health initiatives, especially in underserved regions. Empowering marginalized communities, through financial support for small businesses, women entrepreneurs, and minority-led enterprises. Job creation, by backing industries and projects that generate employment while adhering to fair labor practices. Innovative models in sustainable finance. Sustainable finance has given rise to innovative models and instruments that drive social and environmental impact. Green bonds, bonds specifically issued to fund environmentally friendly projects, such as renewable energy and sustainable infrastructure. Social impact bonds, a performance-based investment where returns are tied to achieving specific social outcomes, such as reducing homelessness or improving literacy rates. Blended finance, combining public and private resources to fund projects that deliver both financial returns and social benefits. Impact investing, directing capital to businesses and funds with the intention of generating measurable social and environmental impact alongside financial returns. Sustainability-linked loans, loans with terms linked to the borrower's performance on predetermined ESG targets. Challenges and opportunities. Despite its promise, sustainable finance faces several challenges. Data and metrics, measuring and reporting ESG impacts consistently remains a challenge. Regulatory barriers, lack of standardized frameworks and policies across countries. Greenwashing, the risk of companies falsely presenting themselves as sustainable to attract investments. Future of sustainable finance. Key trends shaping its evolution include technological advancements, using AI and blockchain to enhance transparency and efficiency in ESG reporting. Public-private partnerships, leveraging collaboration to fund large-scale sustainable projects. Education and awareness, promoting financial literacy to empower individuals and businesses to make sustainable choices. Policy support, governments and international bodies implementing incentives and regulations. Conclusion. Sustainable finance is not just a trend but a critical shift toward a resilient and inclusive economic model. Aligning financial objectives with ESG, environmental, social, and governance principles helps tackle global challenges. It promotes social equity and protects the planet for future generations. The future demands collective action, innovative approaches, and a commitment to ethical and sustainable practices. A sustainable financial system can drive economic growth while creating lasting, meaningful impacts on society and the environment. If you want to learn more Islamic finance Follow us for more insight.